to the Q&A. And what I'll do is I'll stop sharing my screen, if I can learn stop share, and I'll just put our faces on the screen. So we received in loads of wonderful questions, and I'm very excited to go through all of them. I'm going to start actually with a question for Jonathan Trollope. This came in from Trent Howard, and it was actually directed to the board. So I thought I would ask you, Jonathan, to do the honors. The question is, great to see fund grow, but as each year, part of this has been due to capital raising. When would be a good time to review the fees, base and performance paid to the manager?
Yeah. Thank you, Emma, and thank you very much for the question. The answer from the board's perspective, when I say the board, it's the independent directors, Chris Cuff and myself, is actually very simple. There's an investment management agreement which was signed in 2014 and is part of the ASX listing, and it discloses the fees in that. That is a legally binding contract on the company with the board. So the board can speculate, do what we like, but the legal reality is that the board has no power to unilaterally vary the fees paid either way. So it's really, the manager is welcome to come to us and suggest any changes, but that's a call for the manager. It's not up to the board to unilaterally impose a changed fee arrangement on the manager. So that's it in a nutshell from the board perspective. Obviously, if Miles or Emma wish to comment, they can. I mean, I do say in my capacity as a shareholder, the fees were disclosed and I see the value that's been delivered over time. And from my shareholder perspective, I'm happy with the fees which are paid, but each shareholder can have their own view on that. Before I hand back to Emma and Miles, I would like to extemporize and add one thing very briefly. Fantastic news about you guys coming out to Australia. And Emma, you and I share a background from South Africa. I went from South Africa to the UK, and the best thing I ever did was come to Australia 30 years ago. So I give you every assurance that, other than possibly your decision to marry Miles, it's the best decision you've ever made.
Thank you, Jonathan. Thank you for saying that, because I am nervous. I've lived in the UK for 22 years, and so I have a real love for this place. But we'll be coming back a lot. So
I lived in the UK for 10 years. It was a great time, but we are so lucky in Australia, and you will realize that yourself. I give you every assurance.
Thank you.
I actually think most Australians don't quite see how lucky they are compared to the rest of the world. It's a pretty magical situation. But hey, look, just coming back to Trent's question, because this question comes up from time to time, and I don't want to duck it at all. I think, so we're just talking about fees. I think the main thing to keep in mind when looking at fees for us is that we are a very small boutique, and we're trying to do something very different, something that hopefully you can't get from most sort of vanilla investment management firms. As a business, what we do is not very scalable. We're not trying to do what typical long-only funds do, most of whom run many billions of dollars. And in running many billions of dollars, it means they have these enormous economies of scale that we don't have anything like. We totally understand that fees are important, but for this, just to be honest, for the small amount of assets that we run and the need that Emma and I have to attract and keep, the brightest of people who are willing to work all hours of the day, we're never going to be able to run a business model that doesn't charge the fee levels that we charge today. We do something a bit different to most fund management groups, and I'd like to think the results we deliver justify on our proposition, but everyone obviously has to make their own assessment of that. Just to add as a little sort of by note, as Emma said, we have now launched an institutional offering of the fund, effectively talking to some of the biggest and very prestigious institutions around the world, and the fees on that vehicle are exactly the same. We've not had any pushback from those investors and prospective investors on the fees. They see the unique, very resource-heavy strategy that we're running. But anyway, just to sort of add some.
Thanks, Miles. Thank you. No, thank you. Okay, next we have a question from Pete Latham, and I quote, Miles is seen to be power or knowledge behind the throne and the chief investment officer behind the success of GVF. Although you've just added to your investment team, I think there would be many that would ask, What would happen to GVF, its methodologies, strategies, and continuity if, God forbid, anything adverse ever happened to Miles? Sorry, Emma, I realize that behind every successful man who alleges he wears the pants in the family, there is a woman who's telling him what color to wear. Miles, I think you have to take that one.
Okay. I find questions like that, Pete, just really flattering, and in truth, far too flattering. One of the really unfair advantages I have of being the face of the investment team is that in truth, I get to take all of the credit from everyone else's hard work, which I'm sure makes us look a bit smarter than we really are. And if you look at our team today, it's incredibly deep. So James, who's not on the call today, portfolio manager, James and I have been working together for 15 years doing this strategy, and he's actually got several more years of experience than I do. He's several years older than me. We don't see a lot of James. He's a bit camera shy, but he's a tremendous asset to the firm, and he's been doing our style of investing for, gosh, at least 20 years. Then we have Mark here today. He's a recent hire for us, but it's a very senior role and has 16 years of experience of his own. And then lastly, we have Emma, who these days is very heavily involved in a lot of our activist campaigns, which is one of the key competitive advantages that we have in the market, where we generate lots of returns. So if you were to look at our investment resources and consider that we're actually only managing about $200 million, you could argue we're almost a bit top heavy. If we're at a large, big, sort of more traditional investment management firm like a Fidelity or a Perpetual, you'd expect a team like this, a team with this sort of depth of experience, to be possibly running many billions of dollars. So part of, so that's, I guess, the personnel side. Apart from the personnel side, where you could almost argue we're a bit top heavy, we have some very sophisticated systems. We're all kind of math geeks. Mark, to his credit, has a master's in mathematics, and we're always adding to these things over time, making the systems bigger and better, doing more and more things for us. At the moment, in fact, we actually have a very talented coder working with us to push these systems harder and further. So if, God forbid, something ever did happen to me, I have to confess, I probably am replaceable. Our processes and systems would outlive me. And with Mark, James, and Emma, there's an enormous amount of depth and experience already in place. That's not to say I'd be sad not to be part of the proposition, but we are very heavily well resourced. And I think, just to come back to that original point, one of the things we should probably work on in the future, I think, is investors see a lot of me, which probably lets me take a little bit too much credit for the work of the team as a whole.
Thanks, Miles. Okay, next up, we have 6 questions from John Thompson, and I might ask Mark the first of these, which is, given that many of our investments are themselves trading at a discount to NTA, what would you estimate the look-through NTA of GVF to be?
Okay, no, thanks, Emma, and thanks, John. I mean, looking at the size of the underlying average discount across our portfolio is quite often quite a seductive thing to do, and we do know that other groups try and use that metric in their marketing stats. The reason we don't focus too much on that on its own is that we don't think it really tells you anything too helpful, and that's for 2 reasons. One is that it's not the size of the discount that's important, but how quickly you can unlock it. And the second thing is that it depends on how much of that discount you can actually unlock. And it's the combination of those 2 last metrics that are the thing we tend to focus on. But to give you the short answer, it's 18%.
Okay, great. I'm going to give you another one. That was so well answered. I'm going to give you another one. This is also from John Thompson. The annual report lists 47 long positions, 16 of which are less than $1 million. Why is this? Given your discount capture strategy, wouldn't we get more leverage by building bigger position sizes? Surely leverage equals returns under a discount capture strategy.
Okay, no, thanks, Emma, and thanks again, John. So our portfolio often tends to have tail investments in it, like the 16 that John's mentioned there. And that's usually for 2 reasons. The first is that it can take some time to build some of our positions up. So some of those names will be ones that we've just started to build, and you're seeing them there just at a particular snapshot in time, and they look small at that point. The second, but probably the main reason really, is that we're often involved in the winding down or liquidation of a company, and when that happens, we tend to get the vast majority of our capital back very quickly, And then there's this small remaining stub that can sort of sit there and take a year or two to come back to us from the liquidators. And for that reason, we can have a bit of a tail in there, which is just a feature really of the strategy. But overall, the tail is a small part of the fund, and we run large, concentrated positions in high conviction names for the same reasons that you've suggested.
Brilliant. Thanks, Mark. That's excellent. Okay, a question from John that came in, and Jeff, I'm going to ask this one for you. There's two actually. The question is, could you or Jeff Wilson please talk about the prospects for future consolidation in the Australian LIC sector and how we can profit from that? And what's the interaction with war, if any, so far?
And I suppose if you go all the way back, I mean, the interesting thing about the LIC sector in Australia, it's no different to any other sector of the market anywhere in the world. It goes through periods of expansion, it goes through periods of consolidation and contraction. And the great thing about the stock market is, everyone who's on this call, we all love it, because it creates opportunities. And the reason I met Miles and the team was because we were invested in an NTA discount play, and I was in London, and I just wanted to, it was an Australian company, and I'd sort of track down these investors, these big London investors, and just wanted to see what their view was of life. We're just a little Australian, so so to me the great thing is there's always been opportunities. The sector itself has gone, so the last 6 years has gone through a significant expansion phase. Went from 50 odd LICs to over 110. It went from 20 odd billion to 56 billion dollars, and over the last year or so, it's just going through a bit of a consolidation phase. Now, that consolidation phase, I'm pretty sure, there's going to be some more consolidation. I know that because we're going to be involved. I'm not sure. That's in terms of Wilson Asset Management. I don't know what the portfolio of, I know as much as you guys as investors, so I'm not sure if GVS is a shareholder in these entities. But there will be more consolidation. In terms of, say, Wilson Asset Management or WAR in particular, we're trying to do exactly, what GVF's trying to do. And I mean, the interesting thing is when GVF listed, it was very easy. We sent a letter out to all our Wilson Asset Management, the WAM Capital shareholders, saying, look, if you want to get exposure to what we do, buying $1 for 80 cents, then invest in GVF. And then the funny thing is when we're doing WAR, everyone's saying to me, you're doing what GVF's doing. And I said, well, hold it. When GVF started, we were explaining that's what we do. So, I mean, there is a lot of space. It's a $55 billion industry in Australia. GVF only have, I'm not sure, you guys can, Miles or Emma and, or Mark and the team can say what percentage of the assets are in Australia. But, GVF's a global player. We would like to, in WAR, do some global plays, but would more likely be, hey, when Miles and Mark are sort of a full with what they want, and are saying, hey, look, have you ever looked at this? We're already set. Then maybe we'll get a few bones thrown our way. So to me, it's very easy for everyone to coexist. One of the bizarre things is, and this is, you think that because I'm sitting on the board, I know what's in the portfolio, what's going on. I mean, as Jonathan said earlier, there's a management contract, with these guys to manage the money, and that is what they do, and we trust them to do that, and they get paid well because they do that well. Around the time that Blue Sky, they were looking at the old BAF, they were looking at restructuring BAF. And the announcement was made, I think, on a Friday, and I just thought it was appalling, the deal that they wanted to put to shareholders. So I remember ringing Miles that night and saying, look, I think this is terrible, et cetera, et cetera, et cetera. And Miles was saying, hey, look, GVF's got a big position. And like I wasn't I mean, I wasn't aware of that. So to me, there is a great opportunity for us both to buy a dollar of assets for 80 cents. And to me, there are a lot of, everyone thinks that we're the only two players. There's a lot of players out there. GVF's looking on the global stage. We're just looking on the Australian stage. So to me, there'll be more consolidation. There'll be more expansion. There'll be more opportunity.
Yeah, I agree. Thanks, Jeff. That's awesome.
Thanks, Jeff.
Okay, I'm going to move on. John Thompson also asked, please explain the rationale behind the assignment fee paid to BIM. And I'll take this one actually, because it ties in nicely. So BIM is an entity associated with Jeff Wilson, and Jeff was, he's instrumental in helping us set up GVF. He underwrote all the costs of the IPO. He was one of our first investors in the company, putting $1 million on day one. And so he's helped us enormously, and especially with the marketing and introducing us and really just getting us off the ground and on the map. He and the WAM family put a lot of time and effort into launching GVF and the success that it's become today. And so the BIM fee sharing arrangement just reflects all of that. It's a fee. We pay part of our revenue to the WAM family to thank them. And it's a normal relationship where smaller fund management groups often do this to get themselves on the map. Just to say, we have a similar arrangement in place for our new institutional fund in the Cayman, not with BIM this time, but with US partners who have helped us get onto the map with regards to the US endowment market. So that explains hopefully that question. And then we have a last question from John, which was, with cash rates as low as they are, is the hurdle for performance fees, 4% plus the 1-year interest rate swap, still reasonable to shareholders? Given the number of LICs paying more than 5% in dividends alone, I'd suggest this is a very low bar that should be revised to reflect today's market conditions. Miles, I'm going to give that one to you, if you don't mind.
Hi, John. No, thanks for the question. A great question, one that requires a bit of a thoughtful answer. So I'll try my best. But I mean, I guess the first point to make is the one I was making earlier, which is finance theory says the lower interest rates go, the lower your expected returns should be. That's sort of a base assumption of finance. When we set GVF up, we spent a lot of time thinking about this and thinking about what a fair performance fee hurdle would be, one that didn't let us as a manager ever get a free ride, one that set a challenging but hopefully occasionally achievable goal that required us to perform. And the key point to keep in mind when you look at our hurdle is our overall proposition, which is the relatively low risk profile that we take on. And a good example that comes to mind to sort of articulate that is, we have about a quarter of our portfolio today in bonds and debt instruments. We do that because it's a wonderful risk reduction tool. It's a slightly better place to put money than the bank, and because we can find interesting opportunities in that space in the market. But just at a prima facie level, if you're investing in bonds and debt instruments today, the yields you're getting on these things are tiny. 0.5%, 1%, a couple of percent, nothing like the kind of hurdle we have to generate to get to the performance fee target. So for us to be delivering the kind of returns we've been talking about, to be delivering that kind of 11.5% figure, and we've talked about before, we have to be unlocking an enormous amount of value just on top of what we're getting from the general market returns. More broadly, in a world of zero interest rates, if you're running the kind of conservative underlying portfolio that we do, you shouldn't be expecting much in the way of returns. And that, in essence, is the idea behind our performance fee. One final thing to add is that, sorry, I think our son has decided to wake up a little bit early. One final thing to add is that when you look at the performance fee hurdle, it's 4% over cash rates. There's a lot of
you've gone on mute, I think. Sorry,
can you still hear me now?
Yeah.
Oh, great. Thanks, Mark. what I was going to say is that on top of the 4% hurdle, we obviously have to make back our management fees and all of the company's operating costs. So in truth, the hurdle gets up to closer to a 6% level. And if you recall earlier, just thinking about Emma was saying that over the life of the fund, the annualized returns that have come from just our underlying market exposure, so effectively the bits of return we don't take much credit for, that's been about 6% a year. So at a high level, we're really only charging performance fee on the excess returns, the returns we've generated in excess of what the market's done, and that's certainly the way it should be. We certainly haven't earned a performance fee in every year of the fund. It's been a challenging target for us. Hopefully that gives some colour.
Thank you. Sorry, one more from John Thompson, and this was: do you plan another SPP? That's a share purchase plan this financial year or next? I'm happy to take this one. The first thing I would say is that we're in no rush to raise or get to that level that we've talked about, that 300 million. The second thing I would say is that we will never do a capital raise unless we're trading at a premium, and we're trading at a small discount at the moment. And the last and probably the most important thing that I'd say about a capital raising is that it's obviously a board decision. For now, my priority is to get us to a healthy premium, which is proving very difficult when Miles and the team keep punching out stellar monthly returns that keep pushing the NTA higher and higher. It's proving a bit difficult to keep up. So no plans at the moment to raise any capital in the financial year. But as I said, if there is a window to raise money and it is in shareholders' interests and the board is supportive of that, then I'm sure we'd look at it, but there really isn't any rush to do anything. Anyway, I'm hoping that we've managed to answer all your questions, John, but if you have any others that you'd like to ask me or ask us, please do let us know. We can also line up a call as well. I'm going to move now on to a question from John Robinson, and he has said, do you hold any bond class equity in the LIC realm? I find it hard to work out in the monthly reports what allocation is there. Also, I read your report on low returns over the next 7 years, and I noticed there is very little cash holding. I presume that is there. I presume that is. Anyway, I think what he's saying is, but when do you think you might be prudent to raise your cash level? Is what John Robertson has said. Milo, I'm going to give that to you.
Okay. So look, to answer the question straight up, yes, we do. So normally about a third of our portfolio is invested into debt-like securities. So about normally 30 to 50% of the portfolio is in equities. So in the scheme of an international investor, that's not a lot. And about a third is in debt instruments, and then the rest of the portfolio is made up for sort of the interesting things we find around time. Currently, I'd say about 25% of the portfolio is in bonds or debt instruments like that. And as I was saying earlier, we love investing in that space. We don't expect much, almost any of an underlying return from that part of the market at the moment, but we can still unlock value from them, and it's a wonderful risk reduction tool and often acts as a nice hedge against the equity parts of our portfolio. And even though there's not a lot of see-through yield on this part of the portfolio, it's certainly better than money in cash, where in a real after inflation cash rates are essentially negative. So that's to answer your first part. In terms of, I think your second part was perhaps it might be prudent to raise cash levels. I suspect that's a question about risk management, and we get that question from time to time. We think about managing risk at a portfolio level, and the main way we try and keep our risk profile down is through portfolio construction. I know some people use kind of a barbell strategy where they'll invest in equities or high risk asset classes and then sit on cash to try and bring overall portfolio down. Our philosophy is really to have all of the dollars we have at work working, and in fact sometimes we use a little bit of leverage, 5 to 10% of leverage, but then because of portfolio construction we can still run with a relatively low risk portfolio. The lack of correlation between asset classes is wonderful for construction, and then on top of that sometimes we use some modest amounts of hedging, but that's not a huge part of what we do. Whether it's prudent to raise cash, I mean, the reason we would, everyone has their own view, but the reason we approach our philosophy the way we do is that, there's basically a negative yield on cash at the moment. So we'd rather be fully invested, picking up some sort of market return but managing risk in a different way to just uninvest in part of the portfolio.
Okay, that's excellent. A question from Stan McDonald. Hi, Stan. I can see you there. Good afternoon. He asked, "How are the kids?"
Well, they're not sleeping.
So one of them is not playing ball, but no, they're great. Thanks for asking, Stan. And Mark, you also have some kids, Molly and Maddie, and I believe
yeah, I've got two girls, 10 and a 13-year-old. They're good. Loving being back at school and seeing their friends after lockdown. Just getting ready for school now, actually. So
yeah.
Very good. Thank you.
I think Mark was told not to be too loud this morning by the girls in his house. Okay, then we have a next question from Barry Arthur. Do you feel the market feels unsure of where it's going, and are there headwinds to manage into 2022? Miles, I'm going to give that one to you.
Okay. Well, we spent a bit of time going through how we're seeing the big picture, and if I was maybe just trying to condense that down to hit Barry's question, he's asked it in a much more articulate way than me waffling on earlier. I mean, the simple answer is yes. We've had a terrific run. Fundamentally, we don't think that's sustainable for just because markets can't run that fast forever, but also for where we are in the cycle, where interest rates, we've had the big push from interest rates falling lower. If anything, they're either going to stay where they are or go up. If interest rates fall from here, something else pretty horrible to happen. So I think personally, I think people should be dialing down their expectations for next year. I think they also probably want to think about how much risk they're running in their portfolio. If you're desperate to make 15 to 20% a year, you kind of need to live with the volatility that brings. But that doesn't mean it's easy to kind of construct a really bearish argument, and you always sound a bit clever in the market if you do. And I certainly know there's some commentators out there saying we're due another big correction tomorrow or next week. We don't see any plausible reason for that. We just think it's time to be a bit more moderate in what you expect, and to make sure that you're calibrating your risk appropriately. And yes, I would, to hit your first part, I do think the market feels a bit unsure. It was everything was so cheap last year. It was very easy to have a conviction position, whereas today there's a lot less certainty about which way the market will go. We're always a bit relaxed about that because most of our returns don't come from what the market does, and we run with a almost pretty dull market portfolio. But I think we've certainly seen the best of the returns as of today.
I mean, related to that question, and just to say, Sally, thank you so much. Sally Wojcicki, you asked a similar question. Hopefully Miles has now answered that. But a related question from Stephen Bembrick, and he has said, how is the fund positioned for a rising interest rate environment? So, Miles, maybe you could just talk a little bit about that. We've talked about the fact that, interest rates are at all-time lows. Presumably they're going to rise from here. So,
well, that's, I mean, in essence, that's the debate. That's the argument that's bashing itself out of the market every day. On one camp, you have people that say interest rates are going to stay low for the next several years, and that justifies where the market is. In the other camp, you have people saying inflation is going to come roaring back, interest rates are going to go up, and the market will correct. And if that does happen, if inflation does come roaring back and stays roaring back, and interest rates have to follow it up, we should expect a market correction. Again, we're not too concerned about that sort of outcome. We'd be pretty well positioned for that. But one thing to say, I mean, the fact that there's this big debate in the market means that the risk of rising interest rates is one of the known unknowns we have. So we are aware, we can all see that it's a risk, and it means that, Mark Emmert and I and the team can plan for that in our portfolio today. So we've certainly positioned the portfolio to be able to cope with rising interest rates pretty well. It's a little frustrating because it means we give up some returns if interest rates don't start moving up, but it provides a lot of protection in the portfolio. And there's probably three levers we use to do that. One, we have a lot of investment in interest instruments today, but we focus very heavily on floating rate debt instruments, not fixed rate float debt instruments. So what that means is that if interest rates were to start going up, we would benefit from that. We start earning higher dividends, higher coupons from our investments. The other way we deal with that is we have a very short duration on the portfolio, which just means that the trade length of a lot of what we do turns over very quickly. And what you're really worried about in a rising interest rate environment is like long length assets, because they're the most sensitive you can have to interest rates shooting up. And probably the longest length asset you can own is the stock market, because if you own a share in a company, you basically own the present value of its cash flow out to infinity. Whereas if you own a bond that has a 2-year payback horizon, you've got a 2-year investment horizon. So we still have some equity exposure in the market, in the portfolio, about 40%, but compared to a sort of traditional long-only fund that we might have 100% of investments in the market. If we did see interest rates shoot up, you should expect a nice pullback in the stock market, and we would weather that a lot better than those other sorts of funds. And then lastly, and probably most importantly, what we do, everything we go into has this wonderful margin of safety. So even if markets fall, even if the underlying asset value of what we own falls, we can still not lose money or even make money if we unlock enough value on top of it.
Okay, that's great. Thank you, Miles. So that concludes the questions that we got in ahead of the AGM. What I'm going to do now, and as promised by our chair, is I'm going to go through the chat questions, and then at the end, I'm going to ask our company secretary to see if there's anybody who wants to ask a verbal question. If you'd like to ask a verbal question, it's just a case of raising your hand, and then you'll be unmuted and you can speak directly to us if that is your preferred medium. But let's start off with the chat questions. And the first one is from John Tranny. Say what?
Do you want to take that one? I can if you like.
Oh yeah, sure. Do shareholders get consideration to top up their shareholding in a similar way to placement shareholders apart from the SPP?
I think what John's asking is, do you make sure everyone always gets equal access?
Yeah, I mean, yes, just to confirm, John, we have always, any capital raising that we've done, we've always made it available to our existing shareholders first. That's really important to us. And so, yes, the last few we've done an SPP. In 2018, we did a rights issue. And that was a retail rights issue, which meant that it was actually open to brand new investors and brand new retail investors. That was quite expensive, and it's likely to be even more expensive now with all of the new rules that have come in. So, you know, we always like to go the SPP route simply because it's very cost effective, and it allows us to look after our existing shareholders. It also does allow us to do a wholesale placement, usually to wholesale investors, but again, that does exclude new retail investors. Outside of that, the only other ways to top up your shareholding would be to buy shares on the market, or to reinvest the dividends. That's what a lot of shareholders do in order to top up their exposures. I hope that answers your question. We then have a question from Elena. She has said, hi guys, question for Miles. There was a small investment GVF made in VG8, yes, that's true, where the manager is faced with weak performance and increasing shareholder pressure. Would like to hear your view on that position. Miles, Mark?
It's actually one of James's investments, so why don't I take that one?
Okay.
Hi, Elena, and sharp eyes, well spotted. I mean, when you look at the proposition like VG8 and VG1, it's obviously got a lot of attributes, the kind of things we look for. One, a manager that has a really good long-term track record, that has arguably hit a poor patch of recent performance. And two, the ability to invest into their fund at a really attractive entry price. We can be quite light on our feet at times. So we're not a shareholder in VG8 at the moment. We've actually been in and out a couple of times this year, investing when things were sort of extraordinarily wide, and then when we had the opportunity to exit at a much tighter discount, we've taken that. The challenge we have looking at a VG8 is a bit like I think the challenge investors probably had with L1 when it went through a period of poor performance. It's got a long-term track record that's very impressive, you know, a management group that have a real kind of differentiated offering, but it's been a tough performance from an investment point of view, tough ride from an investment point of view for some time now, at a time when market's been going up. So that's probably what's been driving the discount. In terms of VG8, I mean, I'll just share some of our secret sauce. Well, what we've always liked about VG8 as opposed to VG1 is that it's a bit cheaper than VG1. And the low-hanging fruit hasn't really been taken. I mean, one of the really important things about LICs in the Australian market is dividend and yield. Investors really rate that. And VG1 recently announced the dividend policy, which really helped its share price. We would hope or expect VG8 to do something similar in the future, and that's really been the main sort of near-term catalyst that we can see in that one. We're not an investor as of today. That doesn't mean we might not be an investor tomorrow.
Good answer. Okay, Ron. Ron has asked, hi Miles, what are your thoughts on a 13.5% increase in China's PPI and rising US CPI? Are inflation fears coming to fruition?
Gosh, look, the data points are coming thick and fast, right? So that China data point, big kind of sticker shock, and then overnight we had this enormous sticker shock in the US, where US CPI hit 6%, highest in 30 years. The result was well above anyone's forecast. So there's a couple of things that come from that. One, it feeds a lot of ammunition to the part of the market that's arguing that inflation is about to run away and we're about to go back to the 1970s and interest rates are certainly going to charge up. Well, I guess there is a counter argument to that doesn't get as much press, but I think they are winning the argument. We won't know who wins the argument for probably another 6 to 12 months, and that argument is whether this spurt of inflation now is transitory or whether this spurt of inflation today is persistent. We're going to see these kind of prints in a year's time. And the reason I can say that the people that are more sanguine on inflation not being persistent are winning the argument is that we've seen no reaction in the markets. You know, a huge inflation print yesterday. US equity markets kind of took it in their stride. And there's a couple of things underlying the big prints. The obvious ones, energy oil prices have shot up. And then we've had this kind of weird confluence events where we had this big shutdown of the economy. We just kind of put the whole global economy on ice very quickly, and then we've kind of let it rip again. And there's this sort of supply chain pull and push factor that's going on where things will settle down. We will get ships and containers working the way they used to, but in the short term, everyone's been locked at home. They've built up a lot of money and they're fed up and want to spend it all. And we've kind of got this little bump through the supply chain kink we've got to work out. That's not to say that these prints are not worrying. And I guess it comes back to the point I was saying before, if we had to make a bet, we would try not to make bets like this because we don't need to for what we do. But if we had to make a bet, we think it's probably a bit of both. So if these sorts of inflation prints are not going to last, you know, oil prices are not going to shoot up as much as they've done every quarter. Food prices can't shoot up as much as they've done in the last several months, every month forever. But there does seem to be a bit of a change in the way that the economy has been structured. You know, and for people's interest, I think for me the thing that's really stark is coming out of the GFC, the last big crash we had in the last big global recession. There was this real mantra of austerity. We need to sort of live within our means and cut debt budgets and cut public services. And I'm not making a political comment here. I'm just sort of an economist making an observation. So coming out of the last recession we had, the mantra was austerity, effectively, and I'm sure we can all remember that. Coming out of this recession, it seems that kind of old argument has disappeared. No one's talking about that anymore. And the mantra is growth and spend and not worry about inflation. And that mantra has probably come along because when we came out of the GFC and we were using all these new tools like quantitative easing, everyone was paranoid that inflation was going to run away. And in truth, what's happened the decade on, inflation was too low. We invented all these new tools, printing money, and the press went wild that we have hyperinflation in Zimbabwe and all that kind of stuff. And in fact, inflation turned out to be too low. So what the lessons the policymakers have probably learned from that is that we don't have to worry as much as we thought we did. And because, creating jobs and, quality of life is so important, the risk, I guess, is that this time they go too much the other way and they're too keen to spend and not worry about running in debt. And that might lead to a higher underlying inflation pulse than what we've been accustomed to.
Okay, thank you. Okay, no questions from Lumi. Thank you, Steve, for
Jane Crombie one.
We got a Jane Crombie.
Jane, hi,
yes,
Jane.
hi. Okay, so Jane has asked, in my investment committee and governance consulting roles, I've seen a rapidly increasing focus on ESG and climate issues for investors and boards, particularly over the last 12 months. How does GVF factor ESG into its decision making? Great question. Marla, do you want to take that? Do you want me to take that?
Why don't we all bounce it around? I'll
Yeah.
start off stealing something from Mark. So when we take these things very seriously, and as individuals, we care about them enormously. But I guess for investing strategy, and Mark summarized this really well for me once, which was in the world of ESG, the G is really the only thing that matters. If you have correct governance in place, if you're doing the right thing as a principle of your business, then the environmental and the social things will follow. And you can't really get that the other way around. You can't have a wonderful environmental policy if you don't have strong governance, if you don't believe in what you're talking about. Maybe, I don't know who wants to jump in after me, but I'd say for our strategy, governance is the key part of what we do. We go around the world finding assets that are trading too cheap, and they're normally trading too cheap because of some failing in corporate governance. So we come in, fight the good fight, and try and unlock value for everyone and try and improve governance in that process. I don't know if I've stolen all the good sound bites, but do you?
Well, you've stolen masks, that's for sure. Mark, do you want to say anything?
No. The only other thing I'd add to that is that our strategy naturally takes us to companies that are asset backed, and quite often they're pretty diversified, and so they own a lot of assets in a wide range of sectors and different sort of asset classes, and because of that, we can't really kind of apply a very sort of hard and fast strict criteria to what we can kind of invest in. But we spend a lot of time understanding what we own, and so we run a high conviction portfolio, which means we have a sort of deep understanding of what those companies own and what they're exposed to. So we can't apply sort of just kind of cookie cutter approach to it all, but it's something we do focus on, and we spend a lot of time looking at our companies to understand what they're investing in. So
yeah, I mean, Jane, that's such a great question, and it was something. We had to answer a lot of questions with our seed investor who came into our second fund, SVF. Because as you say, I mean, it just feels as though the whole ESG debate has gone on steroids in the last number of months. What I would say is we're pragmatic about it. I mean, as Miles said, there's definitely a focus on the governance for us. Obviously, that's our entire strategy. I also think that there's a lot of lip service in the industry as opposed to actually doing the right thing. For example, there's a campaign we're currently running at the moment where the governance is shocking, and I noticed that the response that we got back, the official response that we got back from the manager or the PR consultant was specifically the head of ESG, and I thought to myself, wow, so you've got an entire head of ESG, but your governance is so horrendous. So I think that there's a lot of titles, and I think there's a lot of
greenwashing.
It feels to me as though there's a lot of like policies in place, and people say that they're doing things, but I'd like to think that we actually are putting our money where our mouth is, and we actually are improving governance around the world. And I feel like that is making a real impact. And also just to say, we actually do sometimes take advantage of the kind of ESG policies that have come in place. For example, recently, Mark had a position where we managed to pick up a really good block of stock because a big institution had decided they didn't want any exposure to the airline industry because of ESG. And so we took that block of stock at a very kind of attractive price. So we're doing, I would say we're doing a really great job on the governance side of things, but we also are looking at the returns of our investors and prioritizing that. So I guess that was where the Queen said she was sick of all the talk and no action. That's right, Rod. That's exactly what she said. Thank you as well for Steve. No more updates from the Lumi platform. I wanted to ask Sushma, can we now open to the floor and ask if any investors want to put their hands up and just talk directly to the team?
But just to finish off, so thank you everyone for making some time and to say we're always here. So no question, big or small is too much. Please email, call, or however you would like to get in touch.